Crypto for Advisors, Digital Asset Tax Preparation. An introduction to managing crypto taxes to avoid a year-round challenge. You're reading Crypto for Advisors, CoinDesk's weekly newsletter that unpacks digital assets for financial advisors. Subscribe here to get it every Thursday. In today's Crypto for Advisors, Bryan Courchesne from DAIM provides information on tax planning for crypto trades. Although we are half a year away from tax season, there are many considerations to track in order to be tax-ready. Then, Saim Akif from Akif CPA breaks down the differences in tax treatment between crypto and equities/bonds in Ask an Expert. As advisors focused on crypto, we're familiar with the unique tax situations this asset class presents. For example, crypto is not subject to wash sale rules, which allows for more efficient tax loss harvesting. It also enables direct asset swaps, such as converting Bitcoin, BTC, to Ether, ETH, or ETH to Solana SOL, without first selling into cash. These are just a couple of features that set crypto apart from traditional investments. However, perhaps the most important thing for investors to consider is the sheer number of platforms they may use and how challenging it can be to track everything at tax time. Tracking your crypto taxes isn't just a year-end chore. It's a year-round challenge, especially if you're active on multiple centralized exchanges, CEXs, or decentralized platforms, DEXs. Every trade, swap, airdrop, staking reward, or bridging event can be a taxable event. Centralized exchange trading. When using CEXs like Coinbase, Binance, or Kraken, you may receive year-end tax summaries, but those are often incomplete or inconsistent across platforms. One major challenge is tracking your cost basis across exchanges. For example, if you buy Amazon stock in a Fidelity account and transfer it to Schwab, your cost basis transfers seamlessly and updates with each new trade. At tax time, Schwab can generate an accurate 1099 showing your gains and losses. But in crypto, if you transfer assets from Kraken to Coinbase, your cost basis doesn't automatically transfer with them. If you're moving assets across multiple platforms, you'll need to manually track every transaction, or you'll face a major headache when filing taxes. Decentralized exchange trading. Things get even more complicated when using DEXs. Apps like Coinbase Wallet, not to be confused with the Coinbase exchange, or Phantom connect you to decentralized trading platforms like Uniswap or Jupiter. These DEXs don't issue tax forms or track your cost basis, so it's entirely up to you to log and reconcile every transaction. Miss a single token swap or forget to record the fair market value of a liquidity pool withdrawal, and your tax report could be inaccurate. That could trigger IRS scrutiny or lead to missed deductions. While some apps can calculate gains and losses from a single wallet address, they often struggle when assets are transferred between addresses, making them less useful for active users. And here's the kicker. If you're actively trading on DEXs, chances are you're not even making money. But even losses must be reported correctly to qualify for a deduction. If not, you risk losing the write-off or, worse, facing an audit. Unless you're a full-time crypto trader, the time and effort required to track every transaction isn't just stressful. It can cost you real money. What steps can I take to make sure I'm tax-ready? There are, however, several ways to prepare properly for crypto taxes. As adoption increases, tax reporting will undoubtedly evolve. In the meantime, keeping track of your trade activity is important to be ready for tax season. Bryan Courchesne, CEO, DAIM. Q. Why are advisors watching crypto closely? Institutional crypto inflows have surged to $35 billion. While crypto is more volatile than traditional assets, major cryptocurrencies like Bitcoin have historically outperformed other traditional asset classes since 2012. Q. How is crypto being treated differently from equities/bonds from a tax side? Crypto differs fundamentally from equities and bonds. Advisors must track each wallet separately for cost basis, starting January 2025. Unlike traditional 1099s, clients often get little to no reporting support from exchanges, especially for self-custodied assets. Q. Do you have any special insights for CPAs and tax advisors? Compliance isn't optional anymore. Starting with 2025 returns, smart tax professionals are combining tax reporting, audit defense, and DeFi accounting into premium advisory services. Saim Akif, founder, Akif CPA. The founder of Newport Beach-based DAIM, is no stranger to managing risk and being on the forefront of innovation as we head into a new digital era and the 21st century financial landscape. Impacted by the housing meltdown during the Great Recession, the Florida entrepreneur relocated to New York City to trade options in the pit of the NYSE. Within a few years, he was managing a desk of brokers as the head of equity derivative sales at a broker-dealer. During that time, he became an options principal and general securities principal holding the Series 4, 7, 24, 55, 63, and currently the Series 65. In 2018, Bryan worked with regulators to create DAIM as the first of its kind registered investment advisor for digital assets. As the CEO of DAIM, he and his team advise and manage digital asset positions for individuals and corporations.